This is such a proud unit of Cirrus research. The latest issue of the Signals report is just out. This is our summary asset allocation monthly that goes out. The title, Mercurial Tariff Policy to Amplify Crowding Break. We've underscored in the last few months how there are multiple threats to equity valuations. Number one is clearly the tariff risks that are really abound currently. Part two, though, is that there is a fundamental risk as leadership stocks such as NVIDIA, their top line growth continues to decelerate. And then part three, we do have, as of the end of January, our crowding model flashed red. So I'll go through all three, but bottom line, the takeaway is that we will remain defensive until some of these uncertainties clear up, until some of the tactical models also settles. This is a look at our Cirrus market crowding model, the polarization measure. What it does is it looks at the multiples of the leadership stocks in the US large cap market. And what this is showing is that the multiples are currently trading well above the normal. This is important because what it says is that while leadership stocks will be expensive for most of the time, somewhere between a parity and a 60% premium, once it hits north of that, as it is currently at 73% reading, this is a big deal. So this is really, the fallout of this has been to really take into account that when this model triggers red, it is a lower absolute returns market. It is also, though, a market where trending factors break down. It's also a place where quality, high quality, and value, undervalued assets either outperform or lose less ground. When we take a look at the leadership basket, both in large and smaller stocks, they're similar and yet they're different. And I think a couple of things to flag here. In the large cap exposure of leadership, clearly we have a sizable technology exposure that makes sense given the run-up that we've seen through, let's say, fourth quarter. In addition, though, the surprising element here is that we've got a sizable financials exposure. And this is important because what this is saying is that the sort of high expectations on deal flow to come through, given the turbulence we're seeing, this market is rethinking this. On top of that, these stocks became more expensive as they ran up in most of 2024. Small cap land, not a crowded market. Exposures are healthcare, tech, industrials, very standard. That said, systemic risk is here. That if the leadership in the market begins to weaken, there's really very few places to hide, especially in the growth indices. Part two, big change. For the second time in about 20-something years, our style oscillator has triggered an overweight to value. This is important because it's very consistent with this idea that if leadership is breaking, the markets are broadening. A broader market is a market in where valuations matter more. So I think some of these elements are very consistent. The problem with this reading is that it doesn't all fit in nicely the way I'd like to tell the story. What we're seeing here in our asset allocation model is that the equity allocation model, which has worked wonderfully since we've really been running this out of sample for the last 5 or 6 years. But what this is saying is the normal exposure for equity to bond allocation is about a 49 handle, 49%. We're currently remain lodged at a 73% allocation. So how can we reconcile these two elements? A couple of things going on here. One, it's quite possible maybe we're taking the short-term hit with the uncertainty, but the earnings backdrop is not bad. On top of that, credit markets remain resilient. And to me, it's a bit surprising, and that's really why the team will continue to look at this closely. But if those two things hold up, then risk assets still matter, but it could be an earnings-driven market, a lower multiple market, a lower returns market. So that's still potentially favorable in this environment. With any questions, feel free to reach out to us. Thank you.